Du lytter til MA 360, podcasten for dig, der kraftigt overvejer at sælge din virksomhed, men ikke helt ved, hvordan du skal starte. Mit navn er Bettina Nygaard, og jeg har som CEO og ejerleder været igennem salgsprocessen hele 2 gange med softwarevirksomheden Scanmark. Og jeg ser det som min mission at give dig svar på de spørgsmål, der vil klæde dig bedst muligt på til at sælge din virksomhed. Tusind tak, fordi du lytter med, og rigtig god fornøjelse med episoden. In Denmark, we have quite a few different smaller and larger private equity companies. We also have a wide range. We already heard in a previous episode about the differences between seed, angel, private equity, etc. Today I have Bas Welten with me from Pride Capital Partners. You are a Dutch company based in Amsterdam.
Yes, that's correct.
And you are right now in the process actually to locate to Denmark, right? Setting up an entity in Denmark, and you are head of Nordics. And Bas, please could you help us understand now from the beginning here, where is it that you actually find yourself? What kind of category do you fall into? Seed, angel, private equity? Where can we find you?
Yeah, I think that's probably the best opening question there could be, because that's also primarily the reason why we want to go into the Nordics, is that we feel the investment landscape in the Nordics is already quite busy. There's a lot of private equity companies, seed investors, VCs. There are a lot of great, sexy names out there. But
VC is?
Venture capital investors, exactly. So primarily focusing on fast growth, top-line growth. But the reason that we wanted to expand to the Nordics is that we truly believe that the way that we invest our capital is a little bit different than what's already out there. And that's because we not only invest in minority equity stakes, but we also invest in debt products, so with a financing solution.
So you don't really have to be an investor. You could also help your partners finance their debt.
Yes, indeed. So we combine the 2 types of capital, and we have our own way of describing it. We call it hybrid capital, the combination of debt and equity, to really make sure that the transaction is in the end the best it could be for all stakeholders involved. And I think also to start with, how do we came up to do such a structure, because it's kind of different, is that originally Pride Capital Partners is a spin-off of a different private equity company, which was a majority buyout investor, your regular private equity investor that comes on this podcast, I guess, as well. And back then we spoke to a lot of software and IT entrepreneurs, as we are a software and IT investor. And what we've learned is that there are a lot of entrepreneurs out there that are willing to do a transaction in the form of attracting growth capital or do a management buyout. So there's a change in shareholdership, or maybe do an acquisition, but they're just not ready to give up the majority of the company and have this major impact on your governance structure, because that's what it will result into. So that's why then we thought of, okay, can we think of a product whereby we can still enable and support these entrepreneurs, but without these significant downsides that it can also bring with him. And that's when we came up with sort of a subordinated debt product, which is equity-like, but it's still a financing solution. So you still get to do this form of transaction without attracting this majority investor. And over time, because we've been doing it now for quite some time, we've also learned that comes with its limitations. Debt, you can also invest that to a certain amount to remain a healthy company, and because it impacts the company in a different manner. And we also learned that a lot of entrepreneurs do want us to be part of that shareholder setting because of our expertise and because of our investment knowledge and network, etc. That's why we also started investing in minority equity positions. And nowadays we just look at the opportunity that is there, make the analysis, have a discussion with all stakeholders involved, and listen to what is it that you really need to make your ambition come to life. And then we can think, okay, maybe the debt solution is better fitting here. Maybe we need to combine it with the minority equity stake, so we can do both. So what we wanted to avoid is to create this one-stop solution where we need to have 80% of the shares or maybe even 100, and then you do an offer and it's take it or leave it for them. No, for us, it's far more about sitting with everybody on the table. What is it that you want? What is it that you want? And then let's try to make a win-win situation, because we have this flexible way of investing our capital.
I think that's a very interesting point, because there may be, I mean, when I've talked to sellers, and especially if you have 2, 3, 4 shareholders in one company that started this company together, and then if you've been in the game for a long time, then you start, or some of them may start to get really tired, feel burned out and so on, but they can't really agree to sell the full company, because there might be sitting other shareholders who are actually pretty happy to hold on to their shares. So I think that's actually pretty interesting what you're saying here, that you are actually able to help with one, debt, but also help those out that are interested in actually take the chips off the table and get out while they can, so to speak, because they are burned out. They don't feel ready to deliver any more into this company. So you'd be able to help the company actually by getting some fresh capital and also take over those shares. I think that's interesting.
Yeah, indeed, that's the case. So we're now discussing, I think, primarily or particularly the management buyout, so a change in shareholdership, where this hybrid form of investing is very relevant. So it could well be that there's a founder or a CEO that is working towards his pension, but he has a very strong and solid management team that he would like to sell the company to. And this could be then a good step in between to do maybe a partial buyout. So he still remains shareholder, but he already gets some chips off the table.
Right, yeah.
And because we also make use of debt, the management can also buy in, making use of the leverage effect.
So Bas, can you perhaps help me understand what Pride Capital has seen is missing in the Nordic markets since you find, your Dutch PE? Why do you think it's interesting to come to Denmark?
I think for us, as I said, I think there's still not a lot of companies that make this combination of debt and equity. So for us, we have the idea that there's a sort of first mover advantage in that space, specifically with the focus on software and IT B2B businesses that we do. That combination, I think, is quite unique. But also from a Pride Capital Partners perspective, we now have an office in Amsterdam, of which we invest in companies in the Benelux region. We have an office in Cologne in which we invest in companies in the DACH region. And what we now do and also enable is that we help German companies, for example, internationalize to the Dutch market, and also Dutch companies internationalize to the German market, often by doing targeted add-on acquisitions. And then it's great to have a Dutch guy in your deal team and a German guy in your deal team, because in the end, that's the way it works sometimes. And what we've also learned, there's a lot of Dutch and German entrepreneurs that are willing to make the move to the Nordic countries, and also vice versa. So for us, it could also be a new step in creating this Northwestern European hub that we really can help our portfolio companies create a foothold in the whole region of Northwest Europe, because that's in the end also a way to create additional value for a company.
So this is part of your strategy. I mean, now if you find a Danish acquisition here, you can help the Danish company expand into the DACH region, and maybe we should just explain what DACH region is. It's the German, Switzerland and Austrian market.
Yes, indeed.
And also, of course, into the Benelux area, Belgium, Holland and Luxembourg.
Yeah, and that's exactly the case. So we're already we're now also working on finalizing our first platform investment in Denmark, but we're already in conversation with our first add-on acquisition for a German company in Denmark. So that's really a way of showing that this is part of our overall investment strategy. It's not only about doing more deals in different countries. No, it's also about
actually help expand
our current portfolio, indeed, and our future portfolio companies.
That's interesting.
Yeah.
So when can you get a bit more specific, in terms of, what are you looking for? What sorts of companies is it that you are interested in?
Well, as I said, it's always software and IT, B2B businesses.
Okay.
So we are a very focused and specialized investor. We almost never, and with almost, I mean, we never deviate from that. Stick to your strategy, stick to what you know. And yeah, we are a specialized investor simply because we think that that's a way that we can have more added value to our portfolio companies, because we have substantial knowledge about this industry and about the business model that comes with it, etc. And then I think more specifically about the type of companies that we invest in. We don't invest normally in startups, for example, but we invest in companies with between 30 and 250 employees. It's always in these regions that we discussed, with a recurring software business model.
Are there certain industries within software, or is it?
No, in that regard, we're quite generic. So often we get the question from investors, but aren't you too focused? It's only one segment, or are you being too specific? But I think software and IT is not only a vertical, it's basically a horizontal that go through every segment of industry that there is. Everybody's making use of it. So whether it's in the leisure industry or in the business industry, like ERP systems, CRM systems, point of sale solution systems, that's all very interesting for us. And I think another element for us that's quite important is that we're looking for companies, especially if we're only investing our debt solution, is that there's not 100% shareholder on board.
Okay.
Yeah. So because, yeah.
Are you looking for companies that are growing, or is that not so important to you? Because I've talked to a lot of private equity companies, and what is really important to them is that, one, they're profitable, and the other one is that they're growing. What is your take on that?
Yeah, I think we all love profitability in the end and growing companies.
Yeah. But is it a must?
Depends on the transaction. Okay. So when there's a change in shareholdership, let's say the founder wants to sell the company to management, then it's not so important that the company is growing 40% per annum. But it's far more about having a stable cash flow and a solid profitability, because you're also using leverage to make that transaction happening. So then growth is less important. You should always be growing as a company, because if you're not, it comes also with some negative vibes and effects in the end, I think. But if we are investing growth capital, then obviously we are more focused on top line growth. And then for us, there's always the need that a company becomes profitable again after 18 months of investing. So we love profitability, but we do understand that if a company wants to grow, it has to become loss-making. But after 18 months, we believe that the strategy should be towards profitability again.
Okay, so Bas, when you then these are the hard facts, of course, but when you look for companies to invest in, how important is management and the management team that you meet to your decision about acquiring a company, or a stake in the company?
Yeah, I think that's a good question, and something that should be mentioned when you're discussing these topics, because for us at least, that's a critical element of doing a deal or not doing a deal. And that's simply because of our investment philosophy itself. It's never the idea for private capital to come on board and then from day one, change the day-to-day operations, replace management, and go into a completely different direction. I think if you go to our website, our main title is that we want to empower and support software and IT companies. So we only invest in companies that have a business plan, a product, and of course a team that we believe in. And then it's our job to further support and enable them achieving those ambitions. So yes, for us, management is key in that part. And we always try to make sure that management is also incentivized in the right manner, that they're part of the setting, the shareholder setting, because that our interests should then always be aligned. And that is that we both want to create value.
So when you look at a company, how do you actually get to a value of that company? How do you know what sort of bids to submit? How do you do that?
Yeah, That's always one that brings to, of course, the discussions in the weekly team meetings, etc. There are multiple ways of approaching this, but I think for us it really helps that we invest only in software and IT businesses again, that we are this specialized investor. Because if you're an agnostic investor, you have to familiarize yourself again with this new segment of industry, and what's a usual valuation, how are your peers valuated, and because we only invest in software and IT businesses, we believe that we have extensive knowledge about this industry and about the multiples that are paid in this industry and what a company is worth. And not only that, because we see a lot of transactions in that industry, we also see a lot of transaction multiples that are of course that other investment companies might not see. That's what I'm trying to say. So I think we have a small advantage in that. So, but usually we look at comparable multiple analysis to determine the value.
But do you look at the top line, or do you look at the EBITDA, or do you look at other parameters, the customer acquisition cost, the lifetime value, or what are the most important KPIs?
No, that's a good one. The ones that we look towards to the most is indeed recurring revenue. So what amount of the revenue is based on subscriptions, and the profitability of the company in the form of EBITDA, and sometimes an even cash EBITDA, which is, I think, a bit technical, could be, but it's very relevant for the software industry, because EBITDA says something about the profitability of a company, but you always invest in the development of these types of software products, and that's an annual expense you have to do. So we also deduct it. So, but that's more of a technical element. So those are the three parameters that we look towards the most, and which are also the most easiest to compare with other similar companies. That's why you use those KPIs.
So when you meet a company that you're interested in acquiring, what sort of material are you asking for in order to be able to, get this feel of this company? What is it that you would like to a company to actually supply you with? It's the last 3 years of accounts, and so on, or what are you asking for?
Yeah, that always goes in stages, and I think I think it's also good to explain a little bit more than on how we get into contact with these companies.
Yeah.
Because that can also be done in a various types of forms. And on the one hand, we have our own relationships, of course, with M&A advisors, like the ones also I think discussed in this podcast, because they advise these companies to go out into the market to get fresh capital. But we get the most deals based on proactive deal sourcing. So because we know what types of companies that we're looking for, so let's say software companies with 30 to 200 employees in this region, for us it's fairly easy to find them ourselves and then reach out to the CEO proactively.
And how do you do that? Through LinkedIn or?
Usually LinkedIn, yeah. Because that's the easiest way to get in contact with somebody, and then it's just a simple message. My name is Bas, I work at Pride, let's connect, and not with the intention to do a deal the next day, but it's just getting to know one another, learn where they're coming from, where are they now, where do they want to go to in the future. And 9 times out of 10 there's no momentum, but what we always try to do is keep in contact with those CEOs or management members.
So long term, getting to know each other, and then one day it might be the right timing.
And when there's timing, then you should be in the back of their head. I once spoke to these guys. I like them. He once connected me with somebody else. He gave me some advice. Before I go out into the market, I'll first reach out to them. And then you have, of course, a head start, because then you are in a one-on-one conversation with this entrepreneur, and that's a far more deal-friendly type of beginning of a transaction. So it's often the case that before we start asking for information like P&Ls and balance sheets and KPIs, it's first about establishing a good relationship with the management that you are hopefully going to cooperate for a long time.
So, having done that, you must also have some, I'm sure, some experiences where you're actually walking away from a deal.
Yeah.
What can make you walk away from a deal?
Well, it happened, but not a lot in our own history, and that's also because if there's going to be a point that we are working towards a transaction, then we indeed ask a lot of information already. So we are quite aware of the position of the company already before we start doing due diligence. So our own investment analysis is already quite substantial, and we've already discussed it maybe once or twice within our own team or even with our investment committee before we go into due diligence and there's the possibility of walking away from a deal. So that's the reason that it did not happen for us a lot. But reasons why it could be is that management presented figures in a different manner than they actually are. Or
okay, so if your expectations, from the first encounter was not met, or at least it didn't match with what you found under your due diligence, then you start, not to trust what you see.
Yeah.
And then the confidence is declining. And at the end of the day, that could lead to you walking away.
Yeah, or indeed that's the case. So as long as the due diligence the outcome of due diligence shows us that indeed everything is as you presented it to us, then the chances are very small that we will walk away, because then we find it an interesting company. That's why we wanted to have the discussion with you. But
I think that, the reason why I'm asking is that if you are, if you have some sort of a salesperson's blood in your veins, which a lot of CEOs do, or at least founders do, then, you're used to when you sell your stuff that you need to, present all the nice looking stuff first and, forget to mention a bit about those less, flattering parts of your product. And I think that it's very interesting to hear you say this, because this has actually a different dynamic where you are actually better off, flashing the skeletons in your closet, so to speak, at least bring them up to your attention so that you don't feel disappointed when you go through the material and maybe find it yourself. So it's much better to, stay up front with these things.
I think that should be the basis of any partnership. It's always about transparent communication, because otherwise it's very difficult to trust one another. In the end, the idea is that you cooperate for maybe a period up to 5 years. So
is that your average ownership period or partner period?
Yeah, it depends a little bit on the deal, whether it's only a debt investment or an equity investment. But let's say 3 to 5 years is our horizon.
Okay.
But
is debt shorter than ownership?
Usually it is, because you have a little bit less control of the exit of the company. But I think that's a little bit more technical. But in short, yes, debt is primarily a little bit shorter, and an equity investment could be a little bit longer. But coming back on when do we walk away from a deal? If we do due diligence, we focus on 3 types of due diligence. We have the financial part, we have the legal due diligence, and I think one that we focus on a lot as well is our commercial due diligence. So
how does that work?
Yeah, that's something that we do in-house. So we always, beside our own analysis, we make use of third parties for financial due diligence and legal due diligence. But the commercial part we do ourselves. And that's simply a reference call with your, let's say, top 6, 7 customers you have, and have a conversation with them for about an hour and just go through when did you start making use of the product? How did the selection process look like? Why did you choose them? How is the cooperation? How's the customer success working out? Are you happy? What should they improve, or what are they doing excellent, for example? And those are always, I think, very insightful, but also a lot of fun conversations, because we learn a lot about the company, how they approach the customer, for example. But we also make, in the end, a report about it and share that with management, because for them,
Okay,
there's
so
also...
they can make sure to correct what, if there are some less flattering parts in it. Yeah,
indeed. And in the end, that's, I think, one of the most important due diligence you can do is your customer a happy one? And is it a good product? And is it vital to its day-to-day operation? Because that's for us, what don't we want? Yeah, customer walking away. So that is
some owners can be quite sensitive to having other parties talk to their customers.
Yeah.
Is that difficult to, get these reference calls, or?
Nah, usually it's not. We always do it in cooperation with management. So we let management introduce us. Why are we coming on board? So if there's a difficult situation at that moment with the customer, maybe it's better not to speak to that customer at that moment in time. But that almost never happened. So we do it in a friendly manner, obviously. And in the end, you can only learn from it. So why wouldn't you do it as a management member? And if you trust us to be your partner, you know that we don't want to hurt the company, because we are going to be a part of the company. So we have the same goal in this. So no, I think practice has learned us that it's not a difficult thing to achieve.
You mentioned earlier that you presented a company to your investment committee. What is an investment committee? Can you tell us about that?
Sure. In the end, the investment committee is a decisive factor whether or not we are going to do the investment. And in our case, the investment committee consists of the most senior members of Private Capital Partners, amongst others let's say the chief investment officer in this case is our managing partner, Lars van Hoenendaal, which is also the founder of the company. And it's up to the deal team to present the opportunity and transaction to the investment committee. And we do that.
So is it only with members from Private Capital, or is it also industry specialists that are part of this committee?
Yeah, in this case, it's only members of Private Capital Partners itself. So it's an internal way of decision. So we don't have to wait for external parties. That helps us because we can act a little bit more swiftly than maybe a different company. We can act a little bit more different when there's a last minute change, for example. But it's up to the deal team to present the company in certain phases. So at the moment that you want to, for example, present a term sheet or a letter of intent, first we have to go to the investment committee. This is the company. This is what they do. This is how we are going to add value. This is the deal that we want to propose. Do you agree? And then they can...
Is it like when you're in school, you have your final exam, then you need to answer?
No, it's not like us standing up and giving a presentation. It's the team sitting in a meeting room discussing the company and having an open conversation whether or not it's the right move to make, or how to improve the offer, or maybe not make the offer at all, or them coming up with a suggestion. And that's something you do multiple times throughout the process.
How many times, typically, are there different stages that you need to consult with your investment committee?
Yeah, so typically we do this 3 times. Once before we bring out the term sheet. Once at the moment that we also make a capital call with our own investors.
Can you explain capital call? I think.
Yeah, I'll come back to that later then, because that's, I think, a whole different topic in the end. And once when due diligence is finalized. So we discuss also the outcome of due diligence, see if there are any red flags, how we should tackle them, if we want to tackle them. And that happens a couple of days before closing usually. And yeah, to come back to the capital call, that has all to do with how our investment company and the fund structure is set up. So we invest from funds, which means that once every couple of years we go out into the market and we approach investors with our own investment strategy and expected returns, etc. And then they get to commit a certain amount upfront. And then over time we invest that committed capital into 13 to 15 companies with one fund. And every time we do a deal, we do a capital call to draw down a small portion of your commitment every time. And now I think we started off doing everything on a deal-by-deal basis, but later on we did this fund structure. So we did our first fund in 2019 of 77 million euro. In 2 days we'll do the final closing of our second fund at 106 million euros, and this year we'll go out for our third fund with a target size of 200 million euro. So
oh wow! So it keeps increasing.
It keeps increasing, yeah, and the team is growing and we're expanding, and so it's a lot of fun to be part of the Private Capital Partners journey at the moment. Absolutely, yeah.
So then you are presenting this to the investment committee, and then they would then give you thumbs up or down. And what you're saying is that normally, I mean, if things are the way they've been presented, you are not walking away from a deal. You are closing the deal. Then, what if if you have found something during your due diligence? Do you use that as some way of pushing down the price towards the buyer, or are you sticking to what you have submitted as an offer, or how does this work? Because maybe you'll find something where you say, okay, then it might not be worth this amount, and you need to have a conversation with the seller, right?
Yeah. Obviously, so you have private equity companies that make it their business to always look for to make a profit in those margins, as we say. That would not be our end goal, to always get something down off the price. If we make an offer, that's probably because at that moment, based on the information we have, we think that's the value of the company. But if indeed it turns out, because of outcome of due diligence, that the profitability is half of what management told us, then obviously we have an opinion on the price set forth, because that's determined on a totally different performance. So then we are going to sit with management on the table and see if we can find a different solution for that. Yeah. So
can you perhaps tell me, why do owners choose you as a new owner? Have you have talked to customers and done commercial due diligence. Have you done that on yourself as well?
Yeah. We that's a good one. And what I always say at the final stages of presenting a term sheet to a company is, go to the website, pick 3 logos that you like or companies that you are interested in yourself, and I'll set up a call and do a reference on us, because for you it's also important to know, who are we as an investor?
Okay, so you do actually the same thing. You ask them to, you provide references to
give them the option,
potential owners.
If they want to, they can call the CEO of a different company to learn how we are. Because we are certain that they're going to give a good recommendation, of course. But for them, it's important to know how we present ourselves as a partner, and how are we when things are not going well with the company. Are we the ones that are going to hit you with the stick and bully you all the time, or are we the ones that tell you, okay, we're going to do this together, these are the steps that we have to take together. So I think for them, they should also know who they're getting in bed with in the end.
So can you tell me a little bit about how do you work together with management? So now we have passed closing, and now you're the new partner. We have heard a lot of stories about American PEs coming in, and there's a lot of focus on spreadsheets and reporting, especially something which I have learned, in the States is very, very common.
Yeah.
How do you run the business together with you're not running the business, of course, but
No.
how do you act as a sparring partner for the companies that you're engaging with?
Yeah, I think that also is related to your previous question. How do we add value to a company, and why do they choose us? I think one of the reasons that people choose us as their partner is because we are focused, because we are specialized in the software IT industry. It's because we reach out proactively to software and IT entrepreneurs. I think what was the statistic in 2022 for us? We had over 850 meetings with software and IT entrepreneurs. So we are well aware of what's going on in the market, which company is willing to sell, which company is willing to buy. So we know what's going on, and that's a real value add for a company to choose us, because especially if they want to do a buy and build strategy, chances are that we are very well capable of helping searching the right targeted add-on acquisitions for you.
Okay, so you are the ones that are doing the sourcing of interesting add-on acquisitions for a
Could well
particular
be.
company.
So and then in the end, up to deal execution, we help management in doing so. And I think what was your last question?
Well, how you engage with how you work as a sparring partner for the companies?
Yeah, so we do that in multiple ways. So the moment we come on board, we usually set up an advisory board, or we become part of the board of directors.
Okay, so do you put board members on the official board, or just an advisory board?
Depends on the type of transaction. So if we do invest our debt solution, then we always install an advisory board. And then we do it in such a manner that we set forth one board member, they set forth one board member, and we choose the third one together. And that could be that one of us is going into the advisory board, or sometimes for the third person, we suggest one of our own funders and investors who has quite extensive experience in the software industry, for example. But if we become a shareholder, then we usually become part of the board of directors. And that's where then we also have our added value, but that's more on a monthly and quarterly basis during the meetings. And besides that, we also organize portfolio management meetings. So, for example, this year we had it in Amsterdam, and then we have all the members of all management teams of all portfolio companies coming to Amsterdam for that day. And we organize breakout sessions, sparring sessions, have software experts coming to tell you how you could run the business more efficiently, for example. But I think more importantly, make sure that the management teams know one another, because it could well be that they could serve the same client or make a pitch together. So as I mentioned, we're about to close our first deal here in Denmark. And I think the first thing on our agenda is to make an introduction with 3 of our own portfolio companies, because we think there could be a good synergy between these companies. So there's from day one then a good kickoff for the management team to find new customers or new cooperations or partnerships. Yeah.
Do you, of course, you need to somehow, let your owners know how are their investments doing. So, are you asking for a lot of reports, or what do you need to know on a daily basis, or weekly or monthly, or?
Yeah, we always ask for monthly reportings, and that's just full reportings on the P&L and the balance sheet and the cash flow, but also some qualitative information. So which customers have you signed? On what type of product development are you working at the moment? Are you attracting new colleagues or not? And that's all input that we also use, one, to monitor the company if it's performing. If we see that performance is lacking, then we of course sit together. How can we make sure that things are moving up again in the near future? And in the end, we needed to, because we also have the obligation to report to our own funders in the end on a quarterly basis. So yeah, we do get our reportings, but we do it on a monthly basis.
But when you do your due diligence, do you ever look into the background of the ownership? I mean, do they have a criminal record, or what? I mean, it must be important to ensure that there are no rotten eggs or whatever in the ownership or in those partners that you are now getting closer to. How do you do that?
Yeah, we do our due diligence on that. Simple fact is that we also do that with our own investors, as in the form as a KYC procedure. But coming to a deal, we far more look at the shareholder setting, as previously mentioned, is that we're not looking for a company with 100% shareholder. And it could also be the case that there are two shareholders who have a 50-50 co-ownership, but then it's, for example, brother and sister. And that's something we always investigate. Not that we don't find that interesting anymore, but what we always want is that the decision making is done in the board meeting room and not in the kitchen table. So that's why you want to be part of that conversation, and that's why you want to have multiple shareholders. So could well be that you have brother and sister who are the largest shareholders, but then there should also be management or us that's part of that shareholder setting. So there's at least the obligation to have the decision-making part in the team meeting room. Yeah.
So how do you define then how do you define success? I mean, what's a successful investment for you?
Yeah.
Is it only money, or?
Yeah, that's a good question. In the end, we have, of course, the obligation to realize solid returns and good returns for our investors. And we are lucky that we are able to have done that over the past couple of years. But obviously, there are far more elements to measure success. In the end, have you realized the plans that you were set out to do at the moment of transaction? So, for example, we did a very good deal in the managed services industry, whereby we executed a very strong buy and build strategy. In the end, the company sold a little bit quicker than anticipated, which resulted in that we had very strong returns. In the end, could always be better, but it was very strong returns. But what did it gain us? It also helped us getting the next deal. And the next deal, because we have realized this strong deal, they see this track record. So that's why then the next company wants to deal the deal with us again. It's not only about the return. Doing a good deal and realizing your ambitions and plan makes you, enables you to get the next deal.
So when you decide, you stayed in the company as an investor for 3 to 5 years, as you mentioned before.
Yeah.
What decides then whether or not it's time for you to get out again? I mean, are you doing a joint decision together with the owners and you're all getting out at the same time, or are you selling your part of the shares to a third party, or what is normal procedure with you?
I think at some point there's always this organic moment that you know that we have learned everything there is to learn about the company and the management, but also vice versa. At some point, we have done everything that we can add to the company. So then there's this natural moment of realizing an exit. And that could be done in several ways. So if we only invest a debt solution, it could well be that we are refinanced and that the management and the shareholder setting stays intact as it is, because then only our debt solution is being refinanced and then we make our exit. But
so what you mean by refinanced is that maybe they go to their banks and they say, okay, so now we are 2 or 3 years into the relationship. Maybe the bank could give us better terms. Is that what is happening?
Yeah, indeed. So our product is indeed a little bit more equity-like. So that's also it's a more entrepreneurial form of financing, and indeed senior bank debt. That's a cheaper form of getting a loan. Then they could refinance us, all in good cooperation, of course. but that could be an exit for us. And if we are a shareholder, then we are probably looking for a strategic exit together. That's something we also decide before we go into the transaction. What is your exit horizon? When do you want to make your exit? Is it for you also the ambition to realize this step and then sell the company in 4 to 5 years, for example? Because then we can do that together. So then that's determined upfront. For us, it's never the case that we are looking to make an exit without management knowing about it, for example. That's, I think, coming back to that part where we really focus on transparent communication. In the end, you're going to do the best exit, at least that's what I believe, if that's also the case, what management in the end wants, because it's management that has to probably sell the company as well in presentations to a potential buyer. So if you're not aligned on that, how are you going to make sure you get the right valuation?
Yeah.
For
That's
example.
A very good point. Well, thank you so much, Bas, for giving us, me and the audience, a good idea of what Pride Capital Partners are. And I wish you the best of luck when you need to start up here in the Nordics. I hope that you'll enjoy Copenhagen, and thank you for taking part in this podcast.
Thank you very much, Bettina, for inviting us and for letting us be part of this podcast. And well, both me and my colleague Nick are very excited to make the move to Copenhagen in July.
I hope you'll enjoy it.
Probably. Thank you.
Thank you. Tusind tak, fordi du lyttede med. Og vil du sende dit spørgsmål vedrørende salgsproces og lignende til panelet, så følg linket i show notes og udfyld den kort formular. Igen, tusind tak, fordi du lyttede med. Mit navn er Bettina, og vi høres ved.